Is this your run-of-the-mill data-driven selling, or is there something more that you're seeing?
I think it's data-driven at the back end, or the to the lows we've been taking. But I think really what we witnessed was a head fake. The U.S. market futures gave us an idea that we weren't in such bad shape as Europe, and I think the European selling used the bids that we had in the United States to raise money somewhere else. It was European selling, I have no doubt. As Simon just pointed out, the pressure on the European markets going into the close, it just closed right now, added to the pressure worldwide. So that, I think, was the most important trigger. The inventory build certainly did not help the energy complex in any way.
But in prior sessions, the U.S. market has been able to shrug off that sentiment from Europe and stage a rally in the afternoon. Are we being set up in any way for that today?
I believe that is entirely possible. Now that Europe's closed, we'll take a look at it. I'll have a better feel for it probably around 2. But that's the way I would trade right now, that you're probably seeing very good buying opportunities if you are a buyer today. That's the way we've been trading at Princeton based on what we're seeing. But we broke all kinds of levels. We broke the 200-day moving average. But the idea of we're still in a trading band. The buy the dippers have not been chased out of the market, because when you bought a dip, you have not been greatly rewarded, but you haven't been punished. And until the buy the dip mentality is punished, that's going to stay in place.
We just lost NASDAQ 5,000, of course, as we've lost 2,100. And I mean, we're not that far from a 16 handle on the Dow. That would get people's attention.
It would get people's attention. On the S&Ps, the buy the dip mentality is around the 2040 level, but we keep hitting that resistance at the 2100 level on the way back up. We have failed to break through that with any kind of significance, and that's why I think we still stay in this band. The troubling place to me in the broader market is really the Russell 2000. It's a place where I think I've seen institutional money investing, but it's not been going well. There's still a great deal of pressure, and the idea that the global economy, the strength of the dollar, is being impacted. The Dow Jones Industrial Average is being impacted because of the China and the pricing of the dollar currency. So the safe haven should be in the Russell. That's not playing out right now, and that has a lot of big money managers nervous.
What does that tell you about the fact that it's normally the Russell and the high yield indexes that investors look to as some sort of leading indicator for where the rest of the broader market is going?
It's like I said, it's disconcerting for me, for a long-term investor, for a trading perspective. A lot of people don't pay attention to the Russell. It's more for the long-term investor, the pension funds that are benchmarked to the Russell. So you thought you would think you would have some safe haven, particularly because, but part of the pressure I think you're seeing is from the biotechnology. There's a huge impact on the selling of the biotechnology in the Russell 2000 itself. If you discount that, I don't think it's performing anywhere near as badly. So if your benchmark as a portfolio manager, you're probably easy to beat that benchmark if you've avoided the biotechs.
So we're through earnings season. What's that next piece of important data that's going to send things further one way or the other?
Well, I think I personally believe that the Federal Reserve is behind the curve, that they should have naturalized rates already, that by actually letting them go to a hard line of a quarter, allowing banks to make money, will bring the money that's sitting on the sidelines. You've been comfortable doing nothing with your money because Janet Yellen has been doing nothing. I believe when you finally get that normalization, that naturalization of interest rates that are not being manipulated by central banks, the markets will have a positive reaction. There was so much money lined up waiting for that move that would take equities down. I don't think that trade's going to happen.
Finally we get bullish sentiment below 40 for the year, first time this year. Is that not a signal to you that we're getting a bit of a washout?
I hope so. It's a little late in the year. That's the problem I have with it. I would have liked to have seen it earlier in the year as an indicator, because I still am long-term bullish. I still think the United States of America meaning the Russell 2000 is going to be the place to have smart money. If you were invested in the DAX and the likes while they're up on the year, in dollar terms, it's not anywhere near as an important move unless you've been in an ETF that's hedged.
Ben Buffett Willis, we appreciate your time this morning. Ben Willis from Princeton Securities.
Arizona for a few days.
Look at this. We're heading toward these 5.5-year highs for the Dow on a closing basis intraday, but I'm splitting hairs, and I'm in no position to split hairs, as you know. We're about 20 points away from that intraday high of 5.5 years ago, but we're at a closing high right now. Ben Willis, you've loved this market. You're going to ride this even higher?
I still love it, but I think we're bumping into some resistance here at the 1480 level on the S&P. And with the VIX being given away at these prices, I may want to buy some protection there for a little bit of a downdraft I can expect before we go higher.
49% bulls and 55% bulls on the institutional poll. Way too much bullishness. I agree. You're going to see a little.
Let's get right to our floor show. We've got traders standing by for you at the New York Stock Exchange, the CME Group, and of course the NYMEX. Ben Willis is standing by at the New York Stock Exchange. And I think, Ben, one of the things that was so interesting about the session Friday afternoon was the Dow getting so close to 14,000. We're 20 points away. Is that some kind of resistance level that we need to be looking at, Ben?
Absolutely. We tend to look more at the S&P futures markets from a professional indicator, and most of the major indices throughout the United States are look to be getting tired and peaking or running into resistance. That doesn't mean the run's over. You have Professor Siegel coming up. I'm sure he'll be able to explain what will happen later on. But for the health of the market, we're going to need to see somewhat of a pullback, a little bit of a reset, give long-term investors a chance to buy some stocks a little bit cheaper than they were on Friday, and that's going to be a good thing in the end.
Stocks are higher in Monday's trading session, and we did get no bailout aid for Greece. But heading into tomorrow's session, we will get the confidence vote for the Greek parliament. How do you think that will affect the markets?
Well, I think if it goes according to plan and he gets his confidence vote, there'll be no impact, because that's what the market's anticipating, in my opinion. However, should it go the other way, I think it would be disastrous.
Aqui com o corretor Ben Willis, que vai comentar como Wall Street está reagindo a essa notícia. Ben, thanks for joining me today.
It's my pleasure.
Ben, GDP announced today, not exactly what we were expecting. How is the market reacting to that?
Well, the market reacted very negatively, not really on the headline GDP number, but on the revision. The last quarter revision basically told us that we were within a few percentage points, a few tenths of a percentage point.
Had a musical career as well. Ben Willis, good to have you with us here on Bloomberg.
Wow, it's fabulous to be here. I'm glad I'm not on camera.
We love hearing you, Ben.
Great voice, Ben. That's wonderful.
Thank you very much.
How long you been singing like that? Forever?
Well, like that, a few years, but I've sung since I was a little boy. I was gifted with a voice from my dad.
Tell us what's going on with stocks right now. Is this a manufacturing-led rally?
It is. It's a manufacturing-led rally out of China. I think you've got some good economic news out of China. You've got some good economic news, relatively speaking, out of Europe, meaning Germany. We followed through into the United States with some fairly decent numbers.
Joining us on Taking Stock for Monday, July 20th, 2012. I'm Courtney Donahoe. Pim Fox out for the day, and my co-host with me, our resident New York Stock Exchange singer, cool dad, markets guru. We have Ben Willis, managing director of Albert Fried. You're an old pro at this.
I wish I were. I just love doing it. Thank you so much for having me, but you make it so easy, so I guess that's why it seems that way.
Aw, thank you. Well, let's get right to the market. Stocks just a bit lower today. We're still above 13,000. The question, though, is what is ahead for the U.S.? What is ahead for our economic outlook? We have the...
Well, it's interesting that the German finance minister was talking about cooperation, since they didn't appear to be wanting to be cooperative going in, suggesting that... that Mr. Geithner and he were not going to get along, but he'd sit down and have a chat with him anyway. But yeah, I think what the market, in my opinion, should be anticipating, we've seen the markets move dramatically higher on pure jawboning, no real tools going to work.